Today I would like to discuss with you Learning Objective 3, how to account for disposal of plan assets. Okay, so you can get rid of your plan assets in three ways: retirement or discard, basically. So equipment is scrapped, or you put it out on the side of the road and it's gone. Sale, sold to another party, or exchange. And we will not be doing exchanges here. The first trick that is highlighted here, and I will remind you always, you have to make sure that your depreciation up to date at the time of disposal. So what do I mean by that? For a lot of companies, depreciation is an adjusting journal entry that is done right before they prepare financial statements, which most likely will be at the end of fiscal year end. So assume you discard or sold equipment in the middle of the year. Then you need to update depreciation. So do that journal entry for depreciation expense, accumulated depreciation, before you do your sale or you discard or dispose of an asset. So you have that extra half a year of depreciation in. And then we will get rid of accumulated depreciation, and we will get rid of the asset account itself, and then see if there's any gain or loss on the transaction. Let's take a look with an actual example. Hubbard Enterprise retires its computer printers, which cost $32,000. Accumulated depreciation of this printer is $32,000. We assume it is up to date. So usually you will see lots of dates in here. When it was discarded, when was the last time you did the depreciation journal entry, so you can figure out, do you need to do one extra journal entry or not. And it looks like it's a fully depreciated asset. How do I know that? Well, you can see that cost was fully allocated on depreciation. So book value at this time is 0. And book value, if you remember, is cost less accumulated depreciation. Sometimes book value could be maybe 1,000. For example, this is 31. But it's still fully depreciated asset. Why then I have 1,000 book value? It's the salvage value that we planned on anyway. So first step number 1, update depreciation. We assume it is up to date. Step number 2, I will take the asset off my books by crediting it. Then right away, don't forget, you will debit accumulated depreciation, because these two go together like twins. So that's always take them off together so you don't forget the accumulated depreciation. So this will get rid of the book value of the asset. Now, good question here. What happens if a fully depreciation plan asset is still useful in the company? That's okay. The asset and accumulated depreciation will be reported on the balance sheet, and you will not be taking any further depreciation until the company retires the asset, just like that. So basically, in this case, book value will be 0, but we still carry it on the books. Otherwise, if you take it off the books, there will be somebody who can drive off with that equipment, and you won't even know because you don't have any records of it. How about slightly different example? Sunset Company discards delivery equipment that cost 18, but accumulated depreciation is only 14. So it looks like we do have a $4,000 book value. Journal entry, like I said, step number 1, make sure depreciation is up to date. Step number 2, take off equipment at cost. Take off your accumulated depreciation. That gives that $4,000 book value. And then make sure your debits equal credits. And in this case, you will be recognizing a loss on disposal. And gain or loss account, it's actually the same account. So I'm going to draw a tiny T up here, and I'm going to put G for gain and L for a loss. Gains behave very similar to revenues. So it looks like if you feel like you need an extra credit, it must be a gain, because normal balance for gains is credit, like revenues. And losses are somewhat similar to expenses, so their normal balances are debits. So in this case, we know it's a loss, obviously, because we discarded a book value of 4 and got nothing out of it. And another hint for you is because loss must be a debit, so I cannot put a gain in there. It's a wrong type. And companies report losses on disposal under other expenses and losses in the income statement, or if it's a gain, it's going to be other revenues and gains, again on the income statement. Okay, what about if we sold equipment? Okay, so it's a very similar process, and we will be comparing through the journal entries the book value of the asset with proceeds, most likely it's cash received from sales. If proceeds, basically what you received on sale, exceeds the book value, that's a gain. If the other way around, you just suffered a loss. Look on a journal entry. On July 1st, Wright Company sells office furniture for $16,000 cash. The original cost is $60,000. As of January 1st, 2020, accumulated depreciation is $41,000. Why did they give you as of January 1st? They're hinting we must have updated depreciation the day before, December 31st, 2019. And as you were reading, you must have highlighted this saying, oops, it's in the middle of the year. Depreciation for the first 6 months is $8,000. We need to prepare the journal entry to record depreciation first or get it up to date. So July 1st, we're going to debit depreciation expense for $8,000 and credit accumulated depreciation for the same amount to date. Okay? Now the next journal entry, you can do this lovely calculation. Unfortunately, sometimes when I import my slides, stuff starts running in together and I don't know why. So how else could you do that? Just one step at a time, one line at a time, or one account at a time. So how do I usually do it? Just like I told you, I will get rid of the equipment at cost. And right away I'm going to put also another one because they go together. I will take off accumulated depreciation at full value. So remember it was 41, then we recorded more of 8, so we ended up with 49, and that's what we took off. So between these two accounts, the 60 and the 49, these two will give you that 11,000 book value. Then step number 2, I will go ahead and plug in cash. Okay, so cash will be 2. What's the proceeds? 16. And then you got to remember that debits must equal credits. And in this case, it looks like I have more debits so far. I need a credit. And credits must be gains, similar to revenues. So I just earned $5,000 gain on this transaction. If you look up here, your proceeds are 16 and your book value was 11, so that's how you made your $5,000. Okay, what if it's a loss on sale? Very similar. In this case, your proceeds are only $9,000. And again, step number 1, take off the equipment at cost and accumulated depreciation. That must be up to date. Then you will plug in your cash proceeds, 9,000 in this case, and then see you've got 58 on the debit side and 60 on the credit side. So it looks like I need $2,000 debit, so it must be a loss, step number 3, because losses are always on the debit side. Okay, so one other quick example. We decided to sell an old truck. Cost, I gotta remove this little box up here. Cost is 30, accumulated depreciation 16, and the truck sold for 17. So we're gonna assume, since they didn't give us anything else, that it is depreciation is up to date. So check depreciation is up to date. Then, as I said, we will plug in cost for the equipment and right away get rid of accumulated depreciation for 16. Step number 2, put cash in there, cash proceeds 17, and then compare. You have 33 on the debit side, and so far you only have 30 on the credit side. So it looks like you need an extra credit of 3. And remember, credits must be gains on disposal in here, or gain on sale. Okay, one more. We decided to sell a truck, cost 30, accumulated 16, and your proceeds are only 10. Again, take off the equipment, take off accumulated depreciation. Okay? Step number 2, put cash in. We received cash. And then compare your debits and credits. You've got 26 versus 30. You didn't need an extra 4 on the debit side. It must be a loss. Okay? Or you can also compare it this way. Your book value, what's the book value? It's cost less accumulated depreciation is 14. So value on your books is 14. You only received 10 for what you sold. Uh-oh, we're in the hole, or we're in the loss of $4,000.